Hi, guys, and welcome to the 43rd edition of WTW, where we talk about the weekend markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. As usual, S&P 500. The bullishness continues. This was Monday, the 8th of September. A slow drift upward. So the bull market continues. Okay. Let's go to the technical picture as usual. We don't have to go through it again. It's the same as always. Bullish, higher highs, higher lows. Let's get rid of this arrow. I know I put it on, but let's get rid of it. It's not really important. The overall bullish picture is still intact. Okay. As usual, when we look at the technical picture, we also look at sentiment. And what do we have here on the CNN Fear and Greed Index? It's neutral. So even at highs, we're still at neutral. There's plenty of room to go to extreme greed. But this week, there are a couple of things that should be noted. Okay, and one of the things that should be noted this week in particular is the AAII Investor Sentiment Survey. Look, it came in even more bearish. As the market is going up, the bearish sentiment is going up. It's incredible. Usually, when you have a market that's this strong with very few pullbacks or very low, how would you call it, like low magnitude pullbacks and still maintaining higher lows, you would see this reversed, 49% bullish and 28% bearish. But no, for months we've been above the average when it comes to sentiment in the AAII Investor Sentiment Survey. So to me, this is confirmation that this bull market will continue. Bull market, technically, bull market in sentiment as well, because sentiment is a contrarian indicator. When everybody is still fearful, as the market is rising, you should be greedy, not super greedy, but you should look for longs. Okay, and that's what we have. So the technical picture bullish. The sentiment backs it up. Don't look at everybody on Twitter who says we're going to crash. It's the end. We're dying. Okay, maybe not right now and not for the next month, especially since next week the Fed is going to cut. Okay, and we can look at that in our macro section, which is coming up now because the technical picture is bullish. We don't have anything more to say. So back to the macro. This week there was a number of macro prints that are important. First of all, we had the PPI, the Producer Price Index, and that went down by 0.1%. This is good for the thesis of rate cuts coming up next week by the Fed. Because last week, it looked very, very heavy, very, very hot. Producers were paying way more for the goods than they were the previous months. Okay, the highest print in a long time, in all of 2025, that's for sure. But now, in August, it reversed downward. So this is a good, positive thing to see for the rate cuts and for the bullish scenario ahead. We also had core inflation come out. This is the core, okay? It's the same. The headline was also the same. So let's look at the core inflation rate that came out. 0.3% for the core CPI, and they're expecting 0.3%. So it's still sticky. The CPI is still sticky at 0.3%. We're still climbing. Yet the producer prices, which is should be affected by tariffs, they're not yet. So inflation is sort of sticking around, but we know that the Fed is going to cut. Okay, and how do we know the Fed is going to cut? Simple. We go to the FedWatch tool, and we see that coming up in September the 17th next week, 96% chance they're going to cut by 100% chance they're going to cut. When the number came out, when the revisions to the job numbers came out that were very, very bad last Friday, 2 cuts, 50 basis point cut was at 10%. Now it went down. So the Fed is probably going to cut just by 25 basis points next week. So for sure it's going to cut. The Fed has never deviated when the entire market expects it to do that, at least 75% or more. It could be as low as 67, 2/3 of the time. If the market is at 67.7 or 66.6666%, of whatever the decision is, the Fed does it. They don't want to surprise the markets. They don't want to screw up anything, especially Powell's Fed. Okay, so that's how we know they're going to cut. But the second thing that should be noted this week that we always mention and we always look at in terms of macro, initial jobless claims. And the initial claims last week were still low, so it was very bullish. But now we said keep an eye on it because it will start coming up if jobs start losing, which we have like a bad jobs market. So now this is pretty high. This is the highest in a long time. Okay, 263,000 applied. Like if you look at the 5-year average, that's pretty much the high. Okay, and see, this is really, really high because of COVID and stuff, but let's see what it is for 2022 onwards. It's a very high print. Is it an anomaly before going down again? We don't know. But we keep saying that we have to watch this as it explodes higher. So this is a sign that we should be looking for or at in the future, because as this climbs, this market is going to start feeling some pain. But for now, the next month or whatever, I don't think so. Especially up until the Fed cuts rates going forward. I'm talking about next week. So that's it for the macro section. The most important thing to note is keep an eye out on initial claims. And the second most important thing was in the first section of our analysis, which is the technical picture. Very, very bearish. 49.5 is this is as if we were, when we hit these April lows, like right here, we were at 49% bearish. So this is a classic wall of worry. And this is why I think the market is going to continue to be bid. Okay. So usually on the third section of the WTW, I like to talk about what interested me this week. So nothing really interested me this week of note. So I thought I'd share with you guys a trade idea that I came up with this week, and really how I go about generating trade ideas and implementing them in terms of from A to Z. Okay, so what I noticed a while back, and by the way, the trade idea now is Bitcoin. Okay, so what I noticed a while back in Bitcoin, okay, all the way here till November 2024, we had a pattern that was forming here of like a inverse head and shoulders, if you will. Where's the drawing tool here? Maybe it's here. Here, brush. You can see here, sort of like an inverse head and shoulders. This is a very, very bullish, very, very bullish pattern. And as you can see, when it breaks out, it tends to go. Okay. We always have to look for a breakout and a reclaim, which is very bearish, but this is very bullish because it broke out and it stayed there. So I was sitting on the sidelines. I didn't really have a position in Bitcoin, but I was hoping that it would go down and retest the breakout point. It almost did in beginning of August, but here is when it started touching the breakout point. And this is what I wanted to buy Bitcoin. Okay, retest, you want to buy it because, as you can see, what happened afterwards, Bitcoin starts going up. And I am bullish Bitcoin because of this breakout that stayed there for like a week or 1 to 3 weeks. And then the retest. This is classic. Okay. So how do I play Bitcoin? You can play Bitcoin with like multiple vehicles, the Grayscale Bitcoin Trust. Okay. This is the point where I wanted to enter. But if you look at the option structure, like I don't want to actually buy Bitcoin, it's too expensive. So if you look at the options structures, which I like to do, I like to play, it wasn't very favorable. Okay, there wasn't a very good risk reward ratio, and you had to put up a lot of money up front to get it. So it could play out, like you will make money if Bitcoin goes to the highs and beyond, but it wasn't ideal. It was maybe a C plus type of trade. All the Bitcoins, the TC, the Fidelity Wise Bitcoin thing is the same thing. Okay, so then if I can't play Bitcoin directly, the better thing to do, or the next best thing to do, is to play the miners, the Bitcoin miners. So which are for me, the three that I like to look at are Coinbase, which is around this level when Bitcoin retested. a MicroStrategy here, and Mara Holdings here. So let's go over each one and which one did I pick and why. So MicroStrategy, first of all, here, MicroStrategy, if you look at it when it was consolidating here, if you look at the option structure, it was very thin, and the risk reward was high risk, high reward. So I would categorize this trade as high risk, high reward in a relatively thin options profile. Okay, because it's if the options, the bid and ask between the options is more than 10%, you're paying a lot. Okay, you shouldn't play it. You can play simple option strategies, just spreads like that. But if you wanted to do a little bit more of a complicated strategy, it's very tough because you would have to like leg in and then leg out in one ticket, and that's very tough. We'll go over that later. Okay, so for me, MicroStrategy was high risk, high reward. Coinbase, I looked at Coinbase, similar thing right here, was consolidating. It was a great chart pattern. You could have bought it, but if you looked at the options, those options too were very thin. But it offered a best risk reward. You could enter it for like average. It was an average play, average risk, average reward. Okay, but if you look at Mara Holdings, that was perfect consolidation. Look at this, very tight, and the options were like very, very tight as well, and you can do a lot of volume. So this offered the best risk reward out of the three. So this is the stock that I chose in order to realize my Bitcoin trade idea. Okay, now what did I do? What did I buy? Okay, I looked at many options. You look at many option structures, and you can just like outright buy the 16 calls. You can buy the 18 calls and maybe do a spread between 18 and 24 or 23, and you can see that there's a relatively okay risk reward, but you would have to like pay a lot to get the 18s, maybe $1 or $2. So then you're back at 20 in order to make profit. So then you would have to go to 24 to like make a 2-to-1 risk reward, 26 to make a 3-to-1 risk reward. So doing it this way, a very simple spread, was not very cost efficient. However, I settled on a multi-leg option structure, which is the following. I decided to buy, the 18 call, sell the 25 call, sell the 13 put, and buy the 10 put. Sounds very complicated. We'll go over it. We'll go over it in more detail soon as to why I chose this, because to me this is the best risk reward. And you could enter these 4 legs in one ticket if you have a broker like Interactive Brokers, and you could enter it for approximately 50 cents, 55 cents, something like that. So you're paying 50 cents for this entire structure, whereas if you were to buy just a simple call at 18, it would cost you $2. Okay, so let's go into more detail explaining how this process is a better risk reward than doing any other play, if you will. Okay, so I took a picture today of, this is the options tree, if you will, in Interactive Brokers. Okay, we're looking here. I know it seems a little bit complicated, but we'll go through it and I'll explain it. It's relatively simple if you understand here. Okay, so here it's the Mara put call structure, and they're side by side. This section is the calls, this section is the puts. Okay, I highlighted it, the strategy that I wanted to play. Inside in the middle here is the strike prices. Okay, and as you can see for the calls, this is the bid and ask, the bid-ask spread and what people are willing to buy and sell calls. And here it's the equivalent, the bid-ask spread for the puts. For example, if you're looking at the $10 strike put, you can buy them at 45 cents and sell them at 47 cents. You can go midpoint, but this is just so you guys can understand here. We also have a very important column that you should look at is the delta, which I look at very carefully. It's very important here, the delta. The delta is important because it tells you the change in the option price versus a $1 move in the underlying. So here, let's go back to the 10 here. We see that the delta for the put is minus 10. The minus sign means that as the price of Mara goes up, the value of the put will go down. So if Mara goes up by $1, this put will go down by 10 cents. Okay, so as Mara goes from, like, the price of Mara at that time was 15.80, so it goes to 16.80, this will go down to 10 cents, so it'll be at 35 to 37 spread. Okay, that's delta. Now we can get more complicated. There's gamma and whatever, but it's not important for this lesson. It's not an advanced option course. This is just, you should know a little bit about options. Let's say it's a medium level, difficulty for gamers. It's a medium level difficulty in options. So I highlighted here the strategy that I told you before. Okay, as you can see, it's highlighted in the bottom here. Okay, so what I did, I looked for the January expiry. Okay, so this is the different expiries. I looked at the January 16, 2026. This is 126 days out. This gives us plenty of time for our trade to materialize. Okay. What we did here was we sold the January put, 13 put, which is here. Okay. The strategy is built on selling the 13 put, buying the 10 put, then buying the 18 call for 205 and selling the 25 call. Okay. This whole strategy, you can see the bid-ask spreads for all of them. It calculates it for you, and it gives you this for the entire 4 legs. You can buy it in one ticket, and it'll cost you between 38 on the bid and 50 cents on the offer. You can put it somewhere in the middle at 45 cents. Maybe you can just lift it at 50 cents and get this whole trade structure. Okay, so this whole trade structure, you can put it together for 50 cents. Okay, as opposed to if you were to just buy the 18 calls, you would have to pay $2. Like we mentioned, if you paid $2 for the 18s, the stock would have to go to $20 by January for you to break even. So you need another $2 and another $2 and another $2 to get like a 4-to-1 ratio or a 3-to-1 risk reward to make just buying the straight call worthwhile of the risk. Okay, so that would make it like $2, 20 to break even, 22 for a 1-to-1, 24 for a 2-to-1, and 26. It would have to go to 26 for you to make a 3-to-1 return, which to me is very unlikely. Not very unlikely, it's unlikely. Okay. So however, you can minimize this risk by paying $2, but then selling the 25 calls for like 85 cents. This will cost you about $1.15, which is better. $1.15, and your maximum upside is $7, because if it goes from 18 to 25, then you would have sold you bought the calls at 18, you sold them at 25. So you're making maximum 7, and then you have no more position here. So you're making $7, and it's going to cost you about $1.15. That's a good risk reward. Okay. However, you would have to go to 19 before you start making money. Okay. And in order, you could do that. That's more simple. Okay. But it would cost you $1.15. Okay. So it would limit you on how many. Let's say you have $5,000 to risk here. Maybe like 50 shares, 50 contracts, which is 5,000 shares. Okay, you can do that. It would cost you $1.50 less. Let's say 48 or 47 contracts. Okay, so that is a doable, viable strategy. However, for you to realize this, it's a little bit more risky. Okay, it's almost a 3-to-1. Okay. However, by incorporating this element, you reduce the purchase price and the riskiness of the situation, of the chances for getting profits. Because by selling the 13s and buying the 10s, you actually gain a credit of like, let's say it's 47, a credit of 70 cents. So from 118 here just to buying this, minus 70 cents, you're basically paying 50 cents for this entire thing. Instead of $2 naked on the call or 115 on just the call spread. Okay, a little bit complicated, but if you rewind and go back, you'll see exactly what I'm trying to say. You're getting you're still exposed to the $7 as you had before, but now you're only paying 50 cents. However, the risk is that the stock will go down to $10, and then you will lose $3 on every share that you bought. Per contract is 100 shares. Okay, so if it ever goes down to here, you can lose $3 on 100 shares. Like if you did 100 shares, it'll be $300, and you're risking, and you're trying to make with 100 shares, you're only going to make $700, because it's 7 cents, $7. So you're going to make 700, but you're risking 300 here, okay, and it's costing you 50 cents on top of everything. So it looks like it's not a pure, like this is the better risk reward because, you're risking 115 and you're making 7. It's almost like a 5-to-1 risk reward. However, you have to understand that this is where the deltas come in and they help you out a lot. Okay, the deltas can not only serve as the initial move, the first derivative move, the initial move of like how an options price changes versus $1 move in Mara. It also is a proxy of the chances of the stock going to these levels by January 16th. It's all embedded in the Black-Scholes formula. You don't have to worry about that. It's not perfect. It works 95, 96% of the time because the Black-Scholes formula uses normal probability distribution, and that's not the real distribution of the market. However, it's 95% accurate. Okay, so what this is telling you is that if I look at the delta here and I look at the 18s and the delta is 47.8, it means there's a 47.8% chance that Mara will finish at 18 in 126 days by January the 16th. Okay, so you can look at that and apply that same rule to this entire structure and to each individual point. For example, for the stock, for you to lose your maximum, $300 per 100 shares, it has to go down to $10. But the odds of that are just 10%. Given the information we have now, things change as the stock price moves. All these things change, the deltas change. But we don't know the future. But we do know, like, given the current information, these are the odds. And they're like 95, 96% accurate. Okay? So there's only a 10% chance for you to lose $300 per 100 shares. But if it goes to 25, there's a 23% chance for you to realize 700. So the expected return is much better. Okay, it's positive. Okay, and all you're doing to risk is 50 cents or $50. You're risking $50 per 100 shares initially. Okay, so this structure right now, given the percentages, okay, for paying such a small amount, 50 cents, the risk reward to me in the next 3-4 months, right? It was September, October, November, December, January, 4 months is much better than just doing this, than just doing a call spread, for example, or just buying the call. Because the odds are that you would have to get to 19, which is like to break even, which is 43% chance, and then 20, if it gets to 20, which is a 38% chance, you're just making a 1-to-1 return, okay? But in order for this entire thing to make a 1-to-1 return, it has to go to 18.50 was break even because it costs 50 cents, and your first option is 18 strike. So if it goes to 18.50, you broke even. If it goes to 19, you made a 100% return at 19. Whereas if you just did this structure, it cost you 115. You would have to go plus. You would have to go to make a 100% return. You would have to go to 115 to something, and that's about between let's say a 36 to 37% chance of happening, whereas this is just a 43. So you're increasing the odds of you being in the money and not losing that much. And just because it costs 50 cents, you shouldn't over leverage. You should base the size of this entire structure on what the maximum loss is here. So if you're willing to lose, let's say $1,000, which is tough. Let's say you're willing to lose $600, okay? You can only put 2 contracts because the maximum loss here is $3. Even though there's only a 10% chance of you realizing it, you should still be very cautious and very careful, because if you put 2 contracts or 200 shares, you will more than likely make money, okay? You will make at least, I think, you can make 100% at least, or this full amount. Remember, the percentage chances of this risk reward, I should say, not the percentage chances, the risk reward of this entire structure is $7 divided by 50 cents. So you have a 14 to 1 return, as opposed to here just a 7 to 1. Okay, that's why juicing this return by adding this bull put spread, if you will, just makes this entire structure much less risky in my view, and with a greater profit potential. You can put down, let's say you have a bigger account and you can put down like $2,000-$3,000 in this, which means, like, let's say it's $2,000. Buy 4,000 shares of Mara here. That's 4,000 shares. Your downside is 12 grand, but your upside is 28 grand, and there's a greater percent chance of you getting it. And all your risk to lose with those 4,000 shares is 2 grand. You're just going to lose 2 grand if things don't go above 18, which is very possible. Okay, so, but the odds are, in any other structure, especially when I'm bullish and I think it's going to go up, I think the odds are slightly greater than this that it goes up. But in terms of risk reward, this structure beats just a simple call spread or just a simple call, in my view. So that's why this is my analysis of how I initially came up with a Bitcoin idea, because I was bullish the market, and being bullish the market, you want to play something that is highly levered to it, which is Bitcoin. Bitcoin will go up more than the market percentage-wise. But the Bitcoin itself, the Grayscale Bitcoin Trust, didn't offer such a good risk reward. Then I went down to the miners. MicroStrategy didn't offer a good risk reward. Coinbase didn't. Eliminate. But Mara did. So Mara did. Now we enter, what do we want to play? How do we play it? Do we play just a call? How much am I willing to spend? What is the risk reward? What am I willing to, because this part here, the final trade structure, why I settled on this, it's not just, trading is not just a science, it's also an art. There's gives and takes, there's ebbs and flows, there's positives and negatives, okay? If I were to just do the call spread, I know exactly what I'm going to lose. I'm going to lose $1.15 per share. Okay, that's it. No risk. But by adding this, I made myself more likely to make money, and I could lose less. Okay, by doing this. However, the risk increases if it goes down to $10 by January. Okay, so it's a give and take. I decided to increase my chances, my odds of success, putting less money down, but also opening myself up if it ever goes down there. The odds are very low that it does. I'm willing to take that 90% chance that it doesn't, okay, while only losing 50 cents for this entire thing. So that is why I settled on this. There's a plus and minus, give and take. Nothing's for free. By adding this, you get this side better, but a chance of you losing more than just doing the call spread. So I decided to play it this way. It satisfies my risk tolerance. I put as much as I'm willing to lose on this put spread, the 13 minus 10. So for me, this risk reward is perfect. This is like an A trade, not an A plus, but it's an A trade for me. Whereas the rest were like C's and B's. So that's it. This is how I go about doing my trade idea generation and how I structure it with options. Not all are this complicated. Doesn't have to be. Sometimes they're just as simple as this or just as simple as this. Okay? And there are other option strategies you can do. But for this particular one, I found that this is the best way to play it. Okay? So let's recap. SPY, bullish, stay bullish. Sentiment is neutral on the CNN Fear and Greed Index. Note, red alert. another mental note, everybody's bearish at the highs. Okay, and the macro is okay, except for the initial claims. That is another like red alert to the negative. This is a red alert to the positive, because this is telling me that the bull market will continue. But this initial claims is telling me that we should keep an eye out, watch it, because jobs are starting to people are starting to file for unemployment. And the Fed watch tool, we know that the Fed is going to cut next week. So that's it for this week. I hope you enjoyed the trade idea generation portion of it and my Mara trade. If you have any questions, you can just DM me on my X page. I'm Harry Yotis. Just check me out. And that's it for this week. And let's see what happens next week. It's going to be exciting with the Fed rate cuts. Later, guys.